Christy knows about the financial ratios. Part 2.
Hey, I hope you have the time to tell me about the other financial ratios.
Yeah, go on.
Tell me about return on equity.
The main aim of an investor is getting the best possible return on a stock. Return on equity measures the earnings that give an idea about the return that an investor gets from the business and overall earnings of the company. It helps the investors in comparing profitability of different companies belonging to the same industry. Return on equity is net income divided by shareholders' equity. The company which has higher return on equity shows high growth. The main benefit arises when earnings are reinvested to generate a more significant return on equity. It is specifically used for comparing the performance of companies belonging to the same sector.
What is interest coverage ratio?
Interest coverage ratio is EBITDA divided by interest charges. EBITDA means earnings before interest, tax, depreciation and amortization. This ratio indicates about the solvency of a business and gives an idea about the number of interest payments the business can solely service from operations. If a stock has an interest coverage ratio above 1, it signifies the company is doing good. But if the value is below 1, it means that the company is facing difficulties in its operations.
What is current ratio?
Current ratio is current assets divided by current liabilities. This shows the liquidity position, that is, how equipped is the company in meeting its short-term obligations with short-term assets. A higher figure signals that the company's day-to-day operations will not get affected by working capital issues. But if the value is less than 1, it is not a good signal. Current assets include inventories and receivables.
What is asset turnover ratio?
The asset turnover ratio shows how efficiently the management of a company is using assets to generate revenue. The higher the ratio, the better it is, as it indicates that the company is generating more revenue than what is being invested. And this also is used to compare stocks belonging to different companies of same sector. It tells about the efficiency of a company in generating sales using its assets. The companies which have low profit have high asset turnover, while the ones with high profit margins have low asset turnover.
What is dividend yield?
Dividend yield is the ratio between dividend given per stock and price of the stock. A higher value of this ratio suggests that the company is doing well. But this should not be only so much. It is very important to analyze all the other factors as well, as the price of penny stocks are very less. So, even if they pay a very low dividend, their dividend yield achieves a high value. This ratio can also be calculated by dividing total annual dividend payment with company's total market capitalization. A stock with higher dividend yield is considered as underpriced, or in coming times, the dividends might decrease. Also, the stocks which have a lower dividend yield are considered overpriced, or the dividends might increase. Different kinds of investors have different perception. Some think that, in spite of paying high dividends, the company should invest it for doing business, so that the stock can give better returns.
Thank you for helping me out.
Also, keep one more thing in mind. Along with the financial ratios, you should also look for other fundamental issues, such as management, cash flow, business model and other such points.
Okay.
For more information visit partradings.com.